Ladies and gentlemen, it's no secret that our appetite collectively, both domestically and abroad, for mobile phone data usage is on the rise per person and overall, as the number of people globally who can afford a cell phone, a smartphone, and other, cellularly connected smart devices like Apple Watches, etc., continues to go up. Now, it's no secret also that I have a little bit of Verizon in the value portfolio, partly because I think that they have done the right thing in investing so much in the 5G spectrum. However, there is something that is something of a vertical to the cell phone mobile data play. That is American Tower Corp. This is, while technically a REIT, has elements of almost being a utility in a lot of ways because it provides that backbone of infrastructure that the cell providers rely upon in order to give us the signal that we use in the first place for that mobile data. Now, American Tower operates in 25 countries on every continent except Antarctica. They have towers in both many developed markets like the US, Canada, Australia, some European markets, as well as in some developing areas like India, several markets in South America and Africa. That means they get the best of both worlds. And it's not as though the appetite for mobile data is doing anything but going up in the developed markets either. And as such, they're positioned very well to take advantage of this increase in demand for mobile data. Without their towers, none of us has cell phone service. Granted, they may not be the sole owner of all cell phone infrastructure, but they have quite a big chunk. They have 43,000, it looks like, here in the US, 181,000 internationally. That's over 200,000 towers under one company. Now, AMT has suffered right along with the other REITs in terms of price performance this year, down 24%. I personally think this could present a compelling opportunity. The last time I looked at this stock, I think they were barely yielding maybe like 2%, which for a REIT or even a utility wouldn't really get me out of bed in the morning. But near 4% with a company who I think their star is on the rise when we look at some of the financial indications. I mean, look at these revenue growth numbers. Now, granted, the last couple quarters look a little sluggish compared to the past, but they probably are not borrowing a lot of money right now at these higher interest rates to acquire more property, right? Why would they do it in this high interest environment when they can take a step back, slow it down a little bit, and wait it out more or less? Because their leases include increases in rent over time. So even if they slow down on adding more, their revenue should still go up a little bit, right? That just makes sense. Now, their shares outstanding also have grown a little bit because, frankly, their share prices have been pretty high for most of the time that I've been looking at them. And with those really expensive shares, selling them on the open market, it's a good way, an efficient way for them to raise capital to add more towers, more so than, taking on, again, debt, which carries interest. But the fact is, the revenue growth has exceeded the rate of dilution. So there's a good chance that they're, raising this capital in an efficient way that's still value creating for the shareholders, in my opinion. Now, looking at, let's see here, the balance sheet, we can see that they have $43 billion in long-term debt, about $55 billion in total liabilities, but to offset that, they do have almost $67 billion in total assets, meaning their book value per share is a net positive. Now, this is not the kind of company where I don't think you'll ever see them reach anything remotely close to their book value. I think that their income stream is way, way, way too consistent and too tied up into something that is integral to our modern everyday life, to the point where I just think they're always going to be at an extreme premium to their balance sheet, and justifiably so. It has essentially very close to the what I would call the safety factor of like a utility, like the electric company or the water company or whatnot. I've said the same thing about other companies that sort of are a part of the essential infrastructure. Things like, for example, Comcast, who is a major provider of broadband internet. That is so essential to our everyday life. It's that part of their business is practically utility. This is much the same way. We rely so heavily on cell towers. I mean, they're the backbone in a lot of ways of Verizon, AT&T, T-Mobile here in the U.S. And abroad, they're the backbone of whatever the major telecom providers are there. Those are the customers that are leasing from American Tower Corp. So it's a really high level of safety and security with regards to their revenue, their cash flow. So that being said, I think whatever yield you have on this is going to be viewed as extremely safe. However, with interest rates being high, what sense does it make? If you're, just, getting in for yield. Okay, when this thing yielded like 2% or whatever it was, like a year and a half ago, it made sense because, interest rates were still pretty low. And hey, this is a company that can grow the dividend, so your yield on cost could get better. But nowadays, you can buy treasuries and really, really easily beat 2% with a safe yield. As such, of course, the price of this will somewhat drop as some investors will reallocate into safer bonds and treasuries more so than equities. But for those of you that see the future trajectory of this and think that, yes, mobile phone usage will continue to be ubiquitous, that the growth trajectory is there, that the potential to grow this dividend income is there, I think right now we're in an environment where you can get some of the highest quality REITs for the cheapest possible prices. This one is definitely, it's on my radar. I don't have any shares as of right now, but I am highly, highly interested in the price range it is now, much more so compared to where it was in the past at well over $250 a share at many points. I'm hoping we could even potentially see it at an even steeper discount, in which case it'll be even more compelling in my view, but only time will tell us on that. Let me know in the comments below if you are interested in American Tower, and if you have any in your portfolio, what your cost basis is, if you're waiting for it to get even cheaper, or if you're avoiding it altogether. As always, please like the video, subscribe to the channel for more, join the Discord link in the description, catch me live most Saturdays on Cashflow Kings, co-hosted with Ryan Dengler. Link to that is in the description. Take it easy, everyone. Have a wonderful day.